All right, well, good evening, everyone. Welcome to our third presentation for Financial Basics. Again, my name is Martin Carette. I am financial counselor with SISIP. I come from a background of financial counseling in the past for a nonprofit organization. Was there for 7 years and then spent about 20 years prior to that in the banking industry. And I'm also a certified bankruptcy counselor. So I've got some good general knowledge of overall, and we're here to help. So today's presentation, we're going to talk about saving and investing, and we're going to talk about fraud protection as well. So some of the things we're going to talk about: how to make your money work for you. So on tips on investment, how to reach goals, how to create financial goals, and again, how to protect yourself when it comes to fraud. Things do get interesting on the fraud side nowadays. You know, technology is a great thing, but it also opened up the door for a lot of bad things. So it's very important to be aware of some of these things. So some of the benefits of this, along with the other sessions, it's about taking control of your financial future, helping you achieve your life goals, providing for yourself and your family, just being a smarter consumer and reduce financial stress, because we all know that can be a big one for a lot of people. So saving and investing, always a big one as far as, you know, how to do it, what's the best way to do it and such. So today's presentation is to give you some information to help you make some of those decisions on how to work with that. So we'll start with this one. Building wealth is like filling a sink with water. You turn on the tap and plug the sink. The stronger the stream of water from the tap, the faster the sink fills. However, if the plug leaks, the water drains out. The sink fills fastest when the tap is on full and the drain is plugged or has a slow leak. It's the same with wealth building. You accumulate saving most quickly when you maximize your earnings and limit your spending. So big paragraph, you know, all sounds very good, but basically what this says is the secret to saving money is within this paragraph. And unfortunately, that secret's a rather simple one. When it comes right down to it, the only way to save money is to not spend it. So it sounds really simple, but that is the actual reality behind it. And then from there is finding the best way to get that money grow for us, to basically make money with our own money through investment types. So all of this always starts with a good budget. So that's really the first presentation that we did was about budgeting. So it's really hard for someone to be doing investment planning and goal planning when we don't have a good budget. So again, it always comes back to that budget because it is your source of information as far as income and expenses and what is left for you to play with. And it also gives you the detailed information you need as far as what is your spending. So then that empowers you to make certain decisions. So a lot of different reasons when we look as far as saving for the future, you know, part of why to do it, to feel more secure and in control, helps us get prepared for emergencies, help reduce stress and conflict. So if we have a large purchase to do, when we have savings available to make those purchases, it's a lot less stressful than charging it. Now we're adding a payment every month and things like that. And it just gives us the ability to spend also with less fear. Gives us the opportunity to afford major purchases and again, avoid debt, new debt or clearing the debt all the way to comfortable retirement. So saving is easy and hard at the same time. It's one of those paradox where, you know, certainly the concept is easy, but then putting into practicality sometimes is where it's a little bit more difficult. So when we're talking about creating saving plans and making those goals, it's important to really set proper goals for ourselves. And that's really where it starts. So we're going to talk about setting dollar amounts and deadlines, you know, how to break down those goals and writing them down. Because when we write things down, again, it helps us keep accountable for it at the same time. So if I say, I'm going to get rid of debt and save money for a rainy day, that sounds good. But it's really meaningless. There's no goal, there's no target. You know, these are just words that have really no actual meaning behind them. If I change that to say I'm going to eliminate credit card debt of $1,600 and I'm going to build an emergency fund of $2,000 by saving $3,600 by a specific date, that is a good goal. It's specific, it's identifiable, we can keep track of it, we know if we're on target or not. But again, some of these numbers are a little big and again, human subconsciously, we look at that, oh, $3,600, you know, for a lot of us, that's a good chunk of money. You know, it kind of scares us a little bit. So then we can break that goal down a little bit. So if I say I'm going to save $200 a month or $100 every pay, instead of saying I'm going to save $2,600, it sounds a lot easier. Oh, I can do $100 every pay. That's not a problem. But when we say I'm going to save $2,600, then all of a sudden, you know, it's scary and kind of fights us a little bit. But it all means the same thing. So again, breaking down these goals can often make them feel more achievable for us. And again, these goals always come back to your budget. So if you have a good budget, you know exactly what your surplus income is. So then you can make sure that when you create a goal, it works within your budget. Because if your budget says you can only save $50 a pay, then this goal doesn't work right off the bat. We know that. So everything always comes back to your budget. But definitely when creating those goals, it's about really breaking them down and making sure that they're trackable, so it keeps us accountable for them. So when it comes to savings, you know, there's always, you know, the emergency fund and things like that. And a lot of people often wonder, okay, well, emergency fund, how much is that? Well, it varies from people to people. Typically, when we talk about, you know, emergency fund, in the financial world, we will say that you should have in savings about 3 months of living expenses. So that amount depends on what is your typical monthly cost of living. And the reason for that is with the 3 months, typically, depending on if something happens, loss of employment, illness, or anything like that, that 3-month period basically covers you for time to get either insurance to kick in, unemployment to come in, and things like that. So the general guideline is about 2 to 3 months worth of living expenses. And when we talk about saving, we're going to talk about paying yourself first, making those automatic, and then growing some of those savings. So making the saving automatics is definitely a big part of this. Human nature, most of us, if every month we need to take money from our checking account and transfer it into a savings account or something like that, it tends to not happen. You know, usually first couple of months, it's pretty good. And then after that, we kind of start forgetting, or we use the money for something else. So making those automatic transfers when it comes to savings is definitely the best way to do it. You can set it up yourself on online banking. You can go to your bank, they can set it up for you. You can do modifications anytime you want. But this is the best way to make sure that it actually happens. So every month or every pay, you can have it scheduled to transfer automatically into a savings account, a tax-free savings account, RSP, any of those. And that is definitely the best way to do that. So when we talk about saving, there's often the question of how much to save. Again, there's the financial aspect, what, you know, books and theory tells us, and then there's reality. So theory is, you know, most financial books tell us we should save about 20% of our income. And one of our previous presentation, we spoke in today's world, how that might not necessarily be realistic with the high cost of living. Average percentage Canadians save currently is about 5% of their income, which is definitely on the lower end of thing. 10% right now is a good target number as far as people to try to see if they can save 10%. But again, that 10% really comes back down to your budget. Again, of what is your surplus and what is your availability. If it's 3% of your income, we need to remember that any saving is better than no saving. So having something started, even if it's $20 a month to start, it's somewhere to start growing. But over time, that $20 a month is going to keep growing because we keep adding to it on a month-to-month basis. So an example here, someone saving, you know, 5 to 10% of their income. So someone earning $2,000 a month at 5% is $100 a month, which turns into $1,200 by the end of the year. Or again, you know, $50 every pay. Again, just smaller number, feels easier. At 10%, $200 a month or $100 every pay will get you $2,400 by the end of the year. So again, it does grow fairly quickly. Extra money, so things that are not part of our day-to-day income source. So, you know, money, gifts, birthdays, Christmas and such, tax-free funds, things of the sort. This money is not part of your budget. Again, that's part of our first presentation about budgeting. This is extra income. So it's always a great opportunity to help grow your saving with that extra money coming in, because it's not planned for at this point in time. RSP, another one that's very always good to look at. So RSP is meant for retirement, so it's a long-term investment. But when we talk RSP, typically it's a time game. So the earlier we start on the investment into an RSP, the more it grows over time. So an example here of Amy and Amanda, we have Amy that started saving into an RSP at the age of 20, puts $1,000 every year into our RSP, and she did that till the age of 34. So at which point she had $15,000 saved. Amanda started at the age of 30, again, put the same $1,000 each year into an RSP and did it till the age of 64. So at that point in time, she would have invested $35,000. So although Amanda contributed for longer and put more in, because Amy started so much earlier, by the time they both reached the age of 65, Amy would actually have more savings due to the compound interest. So RSP is a great investment when it comes to planning for our retirement. That is what it is meant for. But there's also a couple of other benefits through RSP investment. So for money you put into an RSP, it is tax deductible. So it helps you pay less taxes. So there's definitely a benefit there. The other benefit is for home buyers. So looking at first-time home buyers, you are allowed to borrow up to $15,000 from your investment on an RSP to use towards the down payment of a home. Now that $15,000 you do need to reimburse over time. It's basically you need to reimburse $1,000 a year over the next 15 years. But there is no penalty or tax to be paid or anything like that to use an RSP in that fashion. And down payment on a home is usually the area that most people have a hard time with. It's creating that saving. So not only is an RSP a great way to invest for your retirement future, but can also help you as far as buying a home if you're a first-time home buyer. The one thing I always caution people though with RSPs is to not overinvest. And what I mean by that is if you put all your savings into an RSP, the problem is you can't really access them. So yes, you can take money out of an RSP, but if you do that, it's always good to remember that at that point, it is considered income, which means that whatever amount you pull out is taxed. So then you lose at least 30% of that, on taxes. So if you're investing into an RSP for your retirement, that's a great thing. If you're looking to save or put money aside for either emergencies or just create some savings or another goal, you definitely do want to separate that. Because if you put it all into an RSP, although the returns might be good, then when you take that money out, there's going to be a very big negative impact. So you're better to put a little bit less in an RSP, but start early on and continue with that contribution over that long period of time, and then put savings into something else. So when we talk about investments, it can get a little complicated, and a lot of people are not necessarily versed in the world of investing because there's definitely a lot of products out there. But when we break it down, there's really four principal types of investing. So the first type is your standard investment that pays interest through a savings account, savings bonds, GICs, tax-free savings account. That is your first level of investment, which most people are pretty good with. Then the next type of investment would be shares into a company. So looking at stocks, mutual funds, that definitely come with a higher risk, but potential higher return, especially when we're looking at stocks. So the general stock market can definitely give a really good return, but it is a high risk investment, which means you can also lose your investment period. So that one comes with more risk. Mutual funds, which has been very popular for a long time now, is actually stock trading. But the way a mutual fund works is whoever the organization you work with takes that money and pools it with everybody else. So now that gives them bigger or stronger buying power to be able to buy various types of stocks. And then that helps take the risk and split it among multiple investment types. So mutual funds historically have always done very well. Yes, on occasion they will go down like most things, but with time they usually tend to come back up. So mutual funds are kind of an indirect way to do some investment through stocks. Excuse me. Next type of investment is property. So we're talking real estate, art, precious metals. So again, today, some people still invest in gold, platinum. So real estate, either rental properties, apartment buildings and such, which again comes with its own risk, but can also be a good form of investment. And last but not least is a direct investment into a business. So again, either being a partner in a corporation or investing into someone in the hopes that their business will do well to then get some dividends. And again, each of those types of investing come with its own level of risk. So when you're looking to do investment, again, there's a lot of different ways to do this. Most banks nowadays offer this service, usually for free. There's also investment companies you can work with, and obviously there is us here through SISIP. And I'll talk a little bit more about SISIP itself as we kind of go further into this. But when you're looking to do any type of investment, especially if you're going to be working on the open market with a financial advisor, the big thing is to not be afraid to ask questions, right? You need to know who you're working with, because money is a very personal thing. So trusting someone with our money, we need to have a certain comfort level. So things like, what are their backgrounds? What's their portfolio look like? Are they registered? And then it's simply asking questions as straightforward as, well, what can you do for me? What do you offer? What products do you have? Again, every investor and every investing company have different options. Some have more than others. Even looking at the bank level, if you're doing your investing at the branch, for example, it can vary as per what they're able to offer you. So in a perfect example, I live in a rural area. I went to my local bank once to do some investments, except I knew what I wanted, but that small local branch couldn't offer those products because they don't have the people for it. But you go to this same bank in, let's say, Ottawa, larger branch, larger population, they have more products to offer. So asking that question is, what do you have to offer, can help you figure out the best way to, or who to work with. A big one too, especially if you're on the open market, is how do they get paid? Again, banks and financial advisor, they're there to make money themselves. Absolutely, no one's going to pretend otherwise. But some financial advisor do get paid on commission. So unfortunately, in that case, if they're paid on commission, that means that when they sell you certain products, they make more money. And at that point, want it or not, human nature, now it's about them. It's not about you. When it comes to a good financial advisor, financial planner, again, it's supposed to be about you and how they can help you make your money grow. And then how do they work with their clients? In person, over the phone, in the office? Again, just to make sure that you basically work with someone that you are comfortable with. And you can absolutely ask for references as well. Clients are willing to share their experience about, their company and, things that work for them. So the big key is, don't be afraid to ask questions. You're trusting someone with your money. You're hoping to do good investments that will work for you. So the first key is ask questions and get that comfort level. But when it comes to investing, there's a big part about knowing yourself as well. So we call that the 3 no's. So it's about knowing yourself, okay, your investment goals. What are you trying to reach? Your timeline. How quickly are we talking about? And your risk tolerance. And the risk tolerance is a big one. Everyone is different when it comes to investing. Some people are considered low risk. They want to make sure that they're not going to lose anything on their investment. They'd rather make 3% a year than risk losing anything. Then you've got high risk investors where they are willing to lose their investment because of the chance to make that much more. So stock is a perfect example. Can make a fortune, but you can also lose everything. So it's not for everyone. And then you've got your middle ground individual where they're okay with some risk, but not too much, where they don't want to lose anything from their initial investment, but they're willing to risk the return. which are investments where depending on what happens on the market can get you a higher or lower return, but your initial investment is guaranteed. So it's really understanding each type of investment and which one is right for you. Typically, most good financial planners will start you off by running kind of a survey with you to try to figure out what kind of investor are you. Are you low risk, high risk, somewhere in the middle? Because that information is very important to know for a financial planner to be able to offer you the right products. Because if you're a low risk investor and they're talking to you about stock, well, they're not really talking to you. At that point, it becomes clear that they're talking about themselves, of what they're trying to sell you. Because a good investment should make you feel good. If your investments stress you out, then they're probably not the right investment for you. That's not the goal behind it. So it's making sure that you know what is the right investment for you based on your goals, your timelines, and your risk tolerance. And then you have that comfort level as well with the person you're talking to about your investment. So that becomes very, very important. So again, when we talk about registered tax plans, we've touched on a few of these. So a tax-free savings account, these have been out for a while now. Basically, a tax-free savings account is a glorified savings account in the end. Okay, it's very, very similar. They just tend to pay a little bit more interest, and there's a few different investment options within a tax-free savings account as well. And the big benefit is you don't have to pay any taxes on any capital gain. So capital gain being interest you earn. On a standard savings account, if you actually get interest paid through the year because you've got money in there, then at the end of the year, you got to pay taxes on it. So it kind of counters the purpose there. RSP, so again, we talked about RSP, retirement savings plan, again, meant for retirement, long-term investment to gain you additional income for your future. We've got registered education savings plan, so an RESP. Again, that's a great savings plan. That one doesn't give you any tax benefits of any kind, but it's a way to put money aside to help pay for post-secondary education for children. Nice thing about that one too is if you have a registered education savings plan, every year when you do your taxes, automatically, depending on your income level, the government does a percentage match up to help that grow as well. And then depending on household income, there's also programs available where the government will put money into an RSP for children where you don't even have to do any contribution. So that one depends on personal household income. So again, those are things that we can help with because we're aware of all of these programs. Last but not least, we've got what we call the registered disability savings plan. So like the name states, this is for someone who has a disability. So typically they're already getting most likely disability tax credit and things like that. So if they have a registered disability, again, it's a way to put money aside that in time will help take care of them where we're no longer around to take care of the individual with the disability. And similar to an RESP, when you file your taxes, the government do top-ups as well. And there's been many years where they've been very generous with their top-ups as well. So again, it's a way to build some security for someone in our life that has a disability to be able to help take care of them. So these are probably the most common types of, I'll call them general investments that have very specific purpose. Outside of the tax-free savings account, it's just general savings account, but RSP for retirement, RESP to help cover some of the costs for education, and then our DSP to help take care of someone with a disability. So those are the basic type of investment. So when we talk about investing and saving and creating goals, what we're really talking about is financial planning. Okay, so we talked, and I mentioned the word budget already quite a few times, but then now we're going to talk about a financial plan. And there are two very different things. So a budget, okay, if we look at that, it doesn't set out any goals. It just shows current income, current expenses, where the money's coming from, and where it's going. It doesn't include assets. It doesn't include, debts, present or future. Doesn't include next steps. It's purely a snapshot of your current income and expenses, what's available. So when we talk about a financial plan, that's where it really takes it a level up. It's about stating a future goal. Could be retirement, could be buying a home, could be moving to a different country, could be anything. So you kind of get to decide what that goal is. But then at that point, we know that this is something further in the future. So then it'll show future expenses and income. So now we're kind of creating a futuristic budget of what the expectation is to help us get to that plan. It'll show, investments we think we might have, or if we already have some of those investments, where will they be at that point in time? Might show loans that might be required based on our plan. So if it's buying a home, most of us will need a mortgage. All right, what kind of price do we think? And again, the market plays an impact on that, but we're working with the information we know today. So I'm looking to buy a home in 5 years from now, want a $300,000 mortgage. All right, so now it starts to give us direction on how to achieve the goal. Because the more precise and the more information we put down, the more chances that helps us achieve the goal. And then the steps to get there. How am I going to get that? So again, depending on the goal and the timeline and what it is, maybe it's, okay, well, finishing the next couple of years in Europe and then coming back maybe to Canada and hopefully to a specific province for whatever reason where you would like to buy the home. So now you're kind of, here are the steps. Now, unfortunately, we all know that life happens along the way. So we can put all these plans together and then tomorrow something throws it out of whack, which means that a financial plan is not something that we create and then it's just going to happen. So it's a tool to help us achieve those goals. So it's something that we need to follow up and review typically at least once a year, just to see what life's thrown along the way. Maybe now our plan gets accelerated. Maybe it's going to take a little bit longer, again, depending on the events. So some of the benefits of creating a financial plan, there's all kinds of them: minimizing taxes, covering insurance needs, buying a home, paying it off quicker, funding education for children, optimizing benefits, again, retirement savings, dealing with health issues, caring for elderly parents, all the way to managing estate planning. So having a good financial plan is something that can really help us, guide us through those steps, knowing that things can happen along the way, but when we have a good plan, then it's a lot easier for us to make changes and adapt that plan to keep us on target, because that target can definitely be a moving one depending on what happens along the way. So when it comes to financial planning, a lot of things we don't necessarily know about. There is all kinds of free ones available online. You can basically Google, personal financial plan. There's some there. Financial planners often offer to do these plans. Average cost here in Ontario, you're looking at anywhere from $400 to $800 typically for one of these plans, which again, they're just working with the numbers you give them. So it's something you can actually do yourself. There's some material available through the booklet that I believe is available online as well, where it kind of walks you a step by step on, okay, what is your goal? How much money are you going to look for? And then from there it walks you through, okay, what are my assets? What are future assets? What are debts? And kind of walks you through the process to help you that. This one here is a very, very simple one, but still helps you kind of guide you through that creation of the financial plan. And then kind of ask you those typical questions that we don't know to ask ourselves, to make sure that, important deadlines, dates, costs, and things like that. So lots of options, again, something that we can help with as far to help you create that financial plan to figure out your goals. Now, a lot of what I spoke to is is meant towards the general market, financial planners, understanding, getting that trust level. And again, every bank and financial planners out there are out there to make money themselves. Again, they're not offering the service out of the kindness of their heart. Everyone's out to make money, and that's understandable. But again, it's just reminding everyone that the great thing about SISIP is for all CAF members, you get this service for absolutely free. So again, we have our financial planners and insurance as well that are here to serve CAF members and CAF members only. So that's what they're here for. So a lot of the questions, well, are you paid on commission and any of these things? These questions are answered for you already. The answer is no, because we are here to serve the members. That is our number one job and responsibility, is that exactly. So if to eliminate a lot of those concerns, you have a direct option. And when it comes to insurance and investment planning, again, the advantage of SISIP is it is accessible not just for active members, but as veterans, you continue to have access to all of these benefits. So it's a really, really great opportunity to even just, ask questions. If you want to learn more about investment, or simply, just want to see what your options are and what can be done for you, the best thing is just to simply give us a call. We can definitely get you connected with a financial planner to see what's available, what's going to work for you, what are your goals, what are your plans? Because again, this is what we are here to do, and it helps eliminate a lot of those other concerns with some of the individual ones. So definitely there, great service. So I highly encourage it. All right, now we're going to talk a little about protecting yourself. Fraud, 2017, total reported dollars loss for victim of identity theft. If you guys want to take a guess at it in the chat box, we got 11 million, 22 million, and 31 million. So that's a lot of money disappearing. 22, C31, got a few different ones. Yeah, unfortunately, $31 million. And that was in 2017. Last report that I saw for 2019, I believe we were in the around $47 million of identity theft. So identity theft has been a very big one, I'd say in the last 15 to 20 years. It just has been increasing drastically. So identity theft is basically someone pretending to be you. They use someone else's information to open up new credit, apply for credit, and things like that. And they are getting very, very creative. And there's a lot of things that we don't necessarily think of where we are giving people access to our personal information. 2006, 4 million North American fell victim to identity theft. And again, these numbers have doubled since. Average loss per was about $1,000 per individual. Phishing attacks. So phishing attacks is, again, someone trying to steal your information to then be able to use it, stealing passwords and such. Again, per attack, on average, about $1,200. Scholarship scams, again, another very big one, $100 million in 2006. And again, these numbers rarely decrease, they just keep getting up. So it just kind of shows us how much money is being stolen every year through, people taking advantage. So it's really finding ways to protect ourselves. So transfer of funds scam is an example. Most of us have seen this, typically through email. Usually get an email opportunity that if you send money, great investment, you'll get 20% return. They'll send it right back. It always sounds too good to be true, because it usually is, and usually is coming from outside of the country. So Bank of Nigeria is a very common one for these types of scams. If it sounds too good to be true, again, you never respond, you simply hit delete, and that's it. Anything that sounds too good to be true, you always have to ask yourself questions. Lottery scams, still very, very popular. Again, used through email quite a bit. Unclaimed winnings, for some reason, you're going to get a piece of that pie. How come you get this offer, right? It's always got to question why am I getting this really good thing? Well, typically it's because it's not true. It's typically not worth even investigating any of these things. Just delete the email, leave it at that. Some of these things, they've really been moving towards text messaging now. So using, again, computers to automatically generate, text messages, usually includes a link to try to get people to respond through a link. And that link is usually malware that will steal the information off of your phone. So the general rule is always, if you don't know who something is coming from, be it an email or a text message, don't ever click anything, you hit delete. That's it. It's not worth the risk. Phishing attacks, again, trying to steal people information. Still see a lot of these, again, through email and more on text now as well. Usually comes from a bank. They're hoping it's your bank, or it looks like it anyway. And they're usually saying that, your information's been compromised. Please verify your information. And they will supply a link for you to click to go verify your banking information. At which point, if you click on it, it will bring you to what looks like a bank page for you putting in your bank card and password, and now you just gave it to them. So again, never use links that are just sent to you unless it's something you're expecting. Otherwise, if you want to log into your bank, you use the app on your phone the way you normally do, or you go on your computer and you log in the way you normally do. But always be very, very wary of anything that is a random link sent to you. Even if you think it's coming from your bank, just log in the way you normally do to avoid any risk. Item for sale overpayment, again, depending on where you live, can be very, very popular. Often online, so Kijiji of the world, Facebook, and all those places. It's usually a great deal. But the reason it's such a great deal is because it's fake. Depending on where you live, especially anyone that live close to borders, that tends to be a big one. So here I'm close to the US border. So on Kijiji, you see these types of ad very often for this region. You get a car or something like that at a really good deal, and just send a small down payment. They'll meet you at the border, and so on. Usually the down payment, it's a few $1,000s. So on a large purchase, doesn't seem that bad, but as soon as they get that money, they disappear. I've worked with people where this has happened with them for pets, for example, buying, a dog, purebred, they're getting a great deal. They send, a couple $100s as a deposit, and then these people disappear. So just be very, very careful, Google the information. Google the person's email. A lot of times, if it's a scam, it'll come up and you'll see all kinds of things, or the same person has listings for all kinds of things in different countries or different cities. So that's always a good way to kind of verify things, is just Googling the person's name, their email, their phone number to see what comes up. When it comes to email, again, there's still a lot of scams happening through there. And sometimes, unfortunately, the people we know get scammed, and then that's how we get caught. So for example, you might get an email from someone you know, and usually it'll just be a short message and a link saying, hey, I thought you'd like this. Or is this a picture of you? There's just a weird link for you to click on. Again, it's about knowing your audience. Would this person send me something like this or not? And if you doubt, you ask them, hey, did you just send me an email? Always be cautious before clicking on anything, because most time that means they got hacked through someone. So now everyone in their mail list is getting that same email to try to steal people's information. Signs of bogus jobs ad, again, be it for yourself or if you have kids. A lot of fake jobs out there, but they're usually fairly easy to figure out as long as we pay attention. So the big one usually is the pay is really great. They're going to pay you really, really good money for not a whole lot of work. So who doesn't like that, right? Promises of wages in cash is usually another way. And most of those jobs, typically, they don't have an actual address for the business or contact person. So it's a PO box typically. And then that's where they ask you to either open up a new bank account or send them a blank check to test a wire transfer. That is definitely a giveaway there. Again, when you're applying for a job, you're not giving any personal information until you're actually hired for said job. So again, if we pay attention, but they often get people because right off the beginning, hey, they're going to pay me this much to do that job. Yeah, it sounds like a great deal. And that's where they get us. So it's about protecting ourselves. And the first one, it sounds easy, but we don't necessarily realize, we say don't share personal information, but most people don't necessarily realize what is considered personal information. So I'm going to turn that one around a little bit and tell you what is public information. So when we look at any individuals here in Canada, as a Canadian, public information about us is very limited. Basically, anything you could find in a phone book. So your name, address, and phone number is all considered public information. Anyone can look that up, anyone can find that, and there's no real protection. You can have your phone number, unpublished. It still doesn't make it personal information. It is still accessible. Email is actually considered personal information unless it's on a business card. So if you have an email on a business card, now it becomes public domain. It's no longer considered personal information. So when you look at it that way, name, address, phone number, potentially email is considered public, which means that everything else about you is considered personal information, which means that people need to ask permission to get that information, and they need your permission to share it as well. But it's also where we are absolutely very bad as a society about sharing personal information about ourselves. So look at Facebook alone. Facebook has our name. A lot of people will put their date of birth, full date of birth. I have the city that you live in, and what other information you might be putting on there. So that's a lot of personal information. Now, if the only people on your Facebook are people you actually know and friends, that's fairly safe, and if you got your privacy settings so your account's fairly closed, okay, not bad. But we all know people that are friend collectors, and they have all kinds of people on their Facebook, and they're like the social media, and they don't necessarily know these people. Well, now I have your name. I have the city you live in, which means I can probably find your address fairly easily. It's great. You gave me your full date of birth. So I can now apply for credit using your information. And I just put a different address. So the card gets sent to a PO box somewhere, which most banks won't necessarily question. So it really doesn't take a lot of information to start applying for credit into somebody else's name. So it's very, very important to be careful with that. So limit the information you put out there. Again, social media, you see those all the time, little quiz, oh, what was your first puppy's name? And what city were you born in? And again, they make it sound like it's people sharing, but these are also the typical questions that most places ask for security questions. Mother's maiden name, name of first pet, what was your first car? These are very common questions. And you see those types of quiz and fun things online all the time. Well, there's a reason for them. They actually weren't created just for entertainment. They were created because people are using this information to scam us. So it's little things like that we don't always think about that can have a big impact. So be careful with what information you share. Depending on the type of social media accounts you have, you always got to think, would I tell this information to a stranger or not? Because a lot of people, when it comes to social media, we're dealing with a bunch of strangers. Again, destroying documents with personal information, keeping wallets and such safe, carrying IDs you don't need. The social insurance number, for example, is not something we typically need on a regular basis. So again, carrying it with you, if you lose your wallet or whatever, now you're just losing that information. So it's always a good idea to keep that in a safe place. Same with credit cards. If it's something you don't tend to use on a normal basis, you have them for emergency or for whatever reason, if you don't tend to use them on a regular basis, just keep them in a safe place in your home. You know where they are, they're safe, they're there. If you need it, you get it. But if you ever lose your wallet or anything, one less thing to worry about. When it comes to social insurance number, important thing on that one is there are only certain scenarios where you have to give it. So when you get hired for employment, you need to give your social insurance number. When we file our taxes, we need to give it. Or if you apply for any government services, you need to give it. Outside of that, people are allowed to ask you for your social insurance number, but you do not have to give it. You absolutely is a personal choice. All credit information is tracked through social insurance number, but when you're applying for credit, they will ask you for it, but you do not have to give it. It is a personal choice. Go. So again, other ways to protect yourself, limiting the number of credit cards you have. So again, most people don't need 5, 6 credit cards. 1 or 2 is typically more than enough. Having more credit cards, even if you're not using them, is not good for your credit anyway. You're better to have just 1 or 2, maintain those well, and getting more won't help unless there's a specific reason for it. We talk about checking our credit report once a year. Again, that'll tell us if the information that is showing there is accurate. If anyone's used their information to open up credit under our name, we'll see it, because now we'll see a credit account that we are not aware of. Now, the old way to check our credit file used to be you basically either phoned in or wrote into Equifax Canada or TransUnion, and they would send you a copy by paper. The nice thing is, in today's world, there's easier ways to do that. So if we look at TransUnion, we can use what's called creditkarma.ca, which you can sign up online. It's absolutely free. It is legit and secure, and it gives you access to your TransUnion credit report. And then there's borrowwell.com that will give you access to your Equifax credit report. So again, here in Canada, there's only the 2, Equifax and TransUnion. If you sign up through those portals, again, it's free because we see advertisement for credit companies on there, which is not a big deal because we see advertisement everywhere in this day and age. But it does give you a copy of your credit file that you can access at any time. So instead of having to write in or get a paper copy that is hard to figure out if you're not used to reading a credit file, versus these online version, they've really made it people friendly where it's a lot easier to understand. So that's a great way to keep an eye on our credit. And they also have alerts. So if you apply for credit or somebody else does using your information, you'll actually get a notification. Hey, you've applied for credit. No, I didn't. So now you can go and check your file. Again, online, be very, very careful, making sure before you transmit any type of personal information. Again, we know, the larger sites, the Amazons of the world and so on are safe, secured, and tested and true. Probably one of the worst sites for, we'll call them scam advertising are places like Facebook, for example. A lot of advertisement by fake companies offering great deals on a lot of things. And the deals are so great because they're not real. So again, be very, very careful on those social media platform. I always suggest, again, Google the website you're going to for the company, because then it'll show you when was it open. Oh, this website was created 3 months ago. That seems fishy to me. And I'll be the first to admit that I've been caught by some of those before. Absolutely. Saw a great deal on company through a Facebook thing. I thought, hey, I'll give it a shot. I ordered the item, never received it. Now, the nice thing about buying things on credit card is you get fraud protection. So you're able to dispute it, get your money back, but you do learn the lesson from it, that you need to be a bit more careful with those types of things. Again, deleting any emails that ask for personal information, telemarketers, same thing, you just hang up for them. The telemarketing scams this time of year tend to really increase around here. Just random calls. Now they all do phone cloning, so it looks like a local call or anything like that. I don't know how many package I have waiting for me at the border right now, apparently, that are containing illegal material. So there's an arrest warrant for me. There's one for CRA as well that I got last week because I owe taxes. So there's an arrest warrant for that as well. So again, this is all coming through random phone calls and voicemails. Very, very popular. And they basically try to get fear into people that, oh my God, they're going to arrest me. That's just not how the system works, right? So don't even entertain any of those things. Just delete, hang up, and don't worry about it. Keeping computer password safe, again, telemarketers we talked about, and destroying those documents. The big one is just be skeptical. Anything that sounds too good to be true usually is. So unfortunately, it's the world we live in, so we do need to be skeptical about things. Saving bank records. Nowadays, again, with online technology, most banks you can access anywhere from 12 to 24 months of bank records. So not as big of a need as there used to be. but not a bad habit to get into as well. Just again, having that hard copy information just in case. If you ever do suspect any type of identity theft, always contact your bank right away. Just give them a call, go to your branch, just so they can, again, change your accounts, change your passwords, get that taken care of as soon as possible. It's a good idea to notify both credit bureaus, especially with identity theft, because at that point they have the ability to add additional security. So they'll flag your file saying that there has been identity theft. So if you do apply for credit, you can expect some additional questions, but it will protect you at the same time. And then we always suggest to contact the Canadian Anti-Fraud Center and the local police. They're not going to do much for you. I'm going to be very honest about that in these fraud cases, because the reality is most cases you can't catch someone who in another country anyway. But what the Canadian Anti-Fraud Center does is they do collect this data. So again, just making sure that we're aware of what's happening in the world. We're able to share the data and information, find out what kind of scams are happening to hopefully try and help protect people more. And same with local police, they're able to advertise and let people know that these scams are happening in the region. So I call it being a good neighbor by contacting these organizations. It just simply helps reduce the amount of fraud happening in the area. But really the key is just, like I said, being very, very suspicious about any activities. So this concludes the brief talk about saving and investment. Again, we have our financial planners and insurance individuals that are the experts in those domains. I always recommend to talk to one of them. Even if it's just questions, looking at options, seeing what's available, it's definitely the best way to go. And when it comes to fraud protection, again, it's just being suspicious of things, being very, very careful, and really protecting your information. So I thank you all for coming. I hope this was some good information for you all. I have my direct contact information up on the screen. Feel free to send me an email, give me a call. Our 1-800 number is there as well. More than happy to assist in any questions you might have. And hopefully we will talk again soon. Thank you very much.